Hello, everybody. Welcome to 100-Year Real Estate Investor. We are your hosts, Jake and Gino, and this is the show dedicated to long-term personal financial engineering. Today, we got a great discussion. We're talking about how safe is your money in the current banking system. Gino, how's it going?
Doing great, Jake. How you doing, brother?
Always making it happen, big man. We got our second banking crisis in the last 15 years. You've gone from Lehman, now it's SVB, First Republic, and Signature Bank. So, G-Daddy, how are you feeling about keeping hordes of cash in the banking system right now? Because we know Jake, you got it.
I don't know if I got hordes of cash. I think we're going to be a little bit all over the place with this podcast. And I mean that in a good way, because we're going to diagnose what's going on in the banking system, where we think you can put cash as a savings account. We may even talk a little bit about baby money soldiers, because over the past 3 or 4 years, cash is trash. That's been going around.
Man, that got flipped on its head pretty quick, huh?
I'm just saying right now, if your cash is earning 5% in T-bills, you got money, banks, all of a sudden our banker's like, yeah, we'll give you 4.5%. So cash isn't as bad as people thought. And I think it's great. But let's talk about the banks real quick. I read a stat yesterday. I've got it right down here. The 5 major banks that have failed since March, their assets totaling $532 billion. Now, other banks stepped in, but that's greater than all of the 25 banks that failed in 2008. Let's put that into perspective. We haven't even started the financial crisis yet, and all of a sudden you've seen more assets of bank runs.
Put that in your pipe and smoke it. No, if you're just sitting in your car cruising right now, I'm going to ask the G-Dad to say that again, because that's extremely significant. So please tell the folks again what you just said.
I got to read the number because I wrote it down. It's $532 billion that these 5 banks have failed right now. That's greater than 25 of the banks that failed back in 2008. Now, obviously, we have, inflation and those numbers. It's almost like
the Great Recession, though. That's the biggest financial collapse since the Great Depression.
And isn't it funny, Jake, how they sweep it under the rug? Nobody's really talking about it, and it's amazing.
But we're not in a recession right now, Gino.
I would say we've been in a recession for the last 3 years, but
you go from the Great Depression and the big moments in history, right, to the collapse in 2008, which is the Great Recession, and now you're telling me that 5 banks have collapsed and it's greater than what happened in 2008, but everybody's cool. Nothing to see here. Is that basically where we're at?
Yeah, and the 5 banks, Silicon, Silvergate, Signature, Credit Suisse, and First Republic. These are not Jake and Gino banks. These are not the mom and pops of the world. These are massive, huge banks that are getting swallowed up by even bigger banks. Every financial crisis is preceded by bank runs and bank collapses. So we're going to go into a crisis. So we're going to be discussing what can you do with your cash in this podcast, and also what kind of investing you need to do as well. So the first thing for me is we've been getting into whole life insurance.
Hold on. Before we get to that, there's something very important. And I just want to point this out to folks. The last, I'd say since 2015, maybe it probably started in 2010. There's been this weird migration to this quasi-capitalistic, independent, sovereign company model and especially if you look at the pharmaceutical companies, there's this blend between big government and big corporations. And you hear like Kennedy talking about it right now. It's one of his biggest things that he's campaigning on. It's real. It's there. There's this merger, this open door policy between these big companies and the federal government. And you're seeing it now too, where, okay, is there going to be like 5 major banks? Is there going to be a JP Morgan, and all of a sudden they're kind of in bed with the government? How does this sit well, for the everyday American? Is this a good thing to have basically 5 banks controlling everything? I think that's something we got to diagnose as well, because it seems like we're headed in that direction.
When that SVB guy, or Frank Biedman guy, what was his name? The crypto dude. When he has a line item that says Trump not getting reelected in his balance sheet, and
it was like the second or third largest expenditure on their balance sheet, right?
And my point for that is, I'm not supporting or hating Trump.
No, but
I'm
that's
just stating
a problem,
facts
though,
here.
when you have shareholders.
Yes, absolutely. And my point is, why are these banks failing? It's because these regulators haven't been doing their jobs, and they're in cahoots. The banks are in cahoots with the federal government. So they're not doing their jobs. Interest rates have been 0 for the last 5 years. It creates speculation, and it creates rampant speculation. And all of a sudden, these banks are making these risky loans, and they're doing things they shouldn't be doing, and there's no regulators out there. That's why, to me, the banking system is fragile right now. I love the insurance companies. Listen, insurance companies have been around forever. Ben Franklin, He is the Elon Musk of the 1700s. That dude could do everything. I've been thinking about him for the last couple of days because getting ready for this podcast, he's the guy who started the first insurance company in this country called the
I did not know that.
Philadelphia Contributorship for the Insurance of Houses. And it was really trying to get people together, pulling their money together for fires. You know, back then, when there was a fire, the fire brigade would come and they would negotiate with you and say, how much are you going to give us to put your fire out? You don't really have, negotiation. Think about it. My house is burned. Bro, I'll give you everything. Well, you don't have anything getting burned down. So Ben Franklin started.
I got 6 sacks of cornmeal out back. It's all yours.
So think about it. That's why it actually went to the municipalities. That's why the counties and the states and the towns and the cities actually took it over. Pretty good way to use the government. The government should be involved in that. And I think they've done an amazing job of that. But think about how old these companies, they've been around forever. Whole life insurance, these insurance companies. And we're talking specifically right now, let's talk about mutual life insurance companies. They're owned by the policyholders. You know, they're beholden to the policyholders. They're there. Different than stock life insurance companies, mutual. They're owned by the policyholders. They're really beholden to making money and returning it to the people who own.
Almost feels like a credit union model in a way, right?
And Jake, let's talk about credit unions real quick. That's our pivot. For those of you that are investing in multifamily, credit unions aren't banks, but they're a great resource. And if we go back several years ago when Jake and Gino were starting to grow their portfolio, community banks were amazing. They were unbelievable. Then Freddie came in, the agencies, and they came with this product called the SBL. In 2015 and 2016, community banks took a little bit of a licking. A lot of people went to Freddie, and then the Fannie products became more popular. Now, Freddie and Fannie, they're doing less loans right now, and all of a sudden, credit unions have come in and really, that's what's the beautiful thing about capitalism. That's how it should work. When there's a void or there's competition, there's others that can step in. Now, community banks, you know, their SOFR rates, they've got to borrow money because they don't have enough deposits, so they've got to borrow money at a higher rate. So right now, they're making loans at 7.5%, whereas credit unions, they have deposits there. They can go out and make loans at 5.8, 5.9 right now. So all of a sudden, you're seeing capitalism, how it's supposed to work. When there's a void, somebody steps in, and credit unions are stepping in right now, Jake.
Yeah. No, I think it's really important too, because if you're sitting there saying, well, I've kept my money in the bank since I was in college. I use banks. This is what I know. This is what I'm going to do. If the bank collapses, the federal government's going to come in and save the day. You hope. You hope yes. That's the case, right? And look, I have some money in the bank. I hope that's the case for myself. But is that a guarantee, or are you guaranteed up to your $250,000 FDIC? That's what they're telling you that they're going to cover. Anything beyond that, there's exposure there. I don't care. Like in the last, I don't know how many years have they stepped in? Yes. Is that a guarantee? I don't think so. I mean, it's not written. You hope that's the case, but you're rolling the dice. So ultimately, is there an alternative, and is that the safest place for your money, Gino?
I agree, and this is the bank model. The bank model is short-term deposits making long-term loans. Now, does that model look really safe and really sound? Well, I mean, the last 2 decades, we've had 2 financial crises. So how great does that model look? Oversight from the government is really poor. We've seen that in the last 2 crises. It's been really poor. And one thing that I've realized is, you know, when learning about whole life and life insurance, banks have something called BOLI, bank-owned life insurance. I mean, over 2/3 of the banks have it on their balance sheet. It is tier 1 capital. It is the safest capital out there. $184 billion of bank-owned life insurance as of 12-31-2020. That's the last number that I could receive. $184 billion. So what does that tell you? It tells you that life insurance and the cash values are so safe that banks put their money into that. And it's just, to me, amazing. It's a cash management strategy. It's really good for the banks to be able to do that because they use it for employee benefits and they get tons of tax benefits from it. And we're trying here on the show to tell you what wealthy people are doing. They're not going out and buying term and investing the difference. They're going out and putting their money in these products like whole life for long term. Jake always said, hey, you can buy or you can rent term. You're renting term, you're buying and holding long term whole life. And that's what banks have been doing. And we're saying to ourselves, wow, you know, you hear all these people saying buy term, invest the difference. That's not what you should be doing. If you're a long-term investor, if you're a 100-year investor, you should be putting your money into
It's
whole
not the
life.
best deal out there. Yeah.
Exactly. Using it as a cash management strategy and not saying to yourself, I'm chasing yield. Because we've been taught over the last 10 years, you need to put every single dollar at risk. Every single dollar needs to be going out there and fighting and taking things over. You need to have some money in reserve, and you need to be thinking about the long-termism, because, you know, when you're setting up your estate planning and you're setting up what's going to happen once you aren't here, if you're a person who owns tons of assets and doesn't have a ton of liquidity, well, what's going to happen? You need to have a liquidity event at the end of your life when you're not here anymore. And that's why we've been stacking up on whole life. So when something does happen to us, and, you know, we can go into dynasty trusts and what's going to happen to the next generations. I've gotten whole life insurance on my children. I want to get my money out of the banking system, so I bought policies on them. I'm generating cash value in their policies. They have a death benefit, and it's going to be part of my trust. So every time we have children, more children, I want to continue to feed the trust, just like the Rockefellers did. I mean, I love that book. What would the Rockefellers do? That's a model that I want to mirror. And I think everyone who has that wealthy long-term mindset wants to mirror that model. And by the way, I am the beneficiary of my children's policies. I have that cash value, so that when Jake picks up the phone and says, Gino, we got a deal, guess what? I have access to that money. That's still my money.
He blows his Viking horn. Brrr, whole life accounts assemble. And that's where the money comes from, right?
That's right. And when I'm Papa Gino and I want to give it to my children when they're older, in their 30s, I want to say, hey, here, the policy is yours. I can always do that, but I control the policy. And you know what? Someone told me, when's the best time to buy real estate? 20 years ago. Same thing with whole life. When's the best time to buy a whole life policy? 20 years ago. What's the next best time? Today. Buy real estate today and start putting money into whole life today. Don't wait, because right now it's the cheapest you're ever going to get it. As you get older, premium is going to get more expensive due to your health. So don't wait.
It's called buy right and sit tight. Now, going back to what I was saying before about the current banking system and the issues there, we hope the federal government steps in when more of these banks collapse. Here's the component that starts to get a little scary. You've heard Charlie Munger recently talk about the shakiness in the real estate market, specifically with strip malls and office space. Okay, so you have this commercial sector that there's going to be some loans that default. Okay, so now you already have a shaky banking system. Now you're putting more stress on it because they're going to have commercial loans collapse. On top of that, you're seeing this crazy run-up of used car sales in 2020, 2021. There's a lot of data out there saying that those car loans are beginning to fail because people overpay. They got a little, frothy in, buying used cars. Everyone had money, blah, blah, blah. Now the money's drying up and it's rolling back up to the top. And also you're starting to see credit card debt. There's issues coming out there with data from credit card debt. So all this pandemic spending that was going on, I think the chickens are going to come home to roost. That is going to stress the banking system out even more. To what degree? Nobody knows. But if it gets bad, and then the government has to print more money, what does that mean? More inflation. Okay, they're trying to stop that. Rates are higher. I feel bad for Jerome Powell right now. Nobody has a harder job than the Fed chair and the Federal Reserve. They are in a effing pickle. And ultimately, the banks are the ones that are going to get squeezed because they're going to have defaults. They're going to get pinched. They don't have the money to lend because there's not as much money sloshing around anymore. This is a problem. So if you're concerned, there's an alternative, and you can put your money into these whole life policies where these companies, these insurance companies, are not undergoing the same stress that you're seeing in the banking sector. On top of it, you get a death benefit, you get a return, and you're able to reinvest that money into real estate. Look, these are 200-year-old companies in many instances that have never failed. Okay, so I think there's an argument there that there's a lot more safety and security going with these whole life companies as a cash management policy for yourself and your family than utilizing the banks. Gino, what say you?
Jake and Gino's Multifamily Mastery 6 is coming to the Gaylord Palms in Orlando, Florida this October 14th and 15th. Join Jake and Gino as they welcome special guests like Chris Voss, Luke Wren, David Green, and many more. Discover Jake and Gino's 3-step framework for real estate success, enabling students to accumulate $4 billion in assets. MM6 is the multifamily event of 2023 that you do not want to miss. Go to jakeandgino.com/MM6 to reserve your tickets today.
Jake, I want to share this documentary that you made me watch. I really couldn't watch the whole thing because it was making me sick. I wanted to throw up, but it's by PBS, and they did an amazing job. It's called The Age of Easy Money. and we're going to leave it in the show notes because I want you to watch it. It's about an hour and a half long. And I think as an investor, you need to understand what the Fed is there for. The Fed is there to fight inflation. And you see this dichotomy where, Democrats want low interest rates because they don't want unemployment. And Republicans want low interest rates because they want people to buy assets and have those assets inflate. So you have wealthy people getting wealthier, and you have middle and low income people continuing to have jobs. You can't have your cake and eat it too. That reason they should have raised interest rates a lot sooner, and understanding this and understanding market cycles and understanding how you can capitalize on this. You can see this coming. You may have missed it now, but that's okay. There's going to be continual market cycles. When are rates going to drop? You can understand that rates have to drop. Right now, there was Jay Parsons from LinkedIn just mentioned that rents have actually, it's a lagging indicator, but rents in multifamily have actually stopped and markets are slowing down. So that's good for inflation. They finally hit. It took about 12 months to see that. So right now, as an investor, I know that inflation is going to slow down because that is one of the biggest drivers, rents, believe it or not, in inflation. And as I see that doing that, I'm going to plan accordingly in the next 12 to 24 months because I know the Fed is going to drop rates. They raise rates to slow down the economy, to get this inflation under control so Jake doesn't go out and buy 2 Lambos. He only buys 1. When rates get up, all of a sudden Jake says, you know what, things are too expensive. I'm going to pull back my spending. Economy slows down. As the economy slows down, what do they have to do? They have to stimulate the economy by dropping rates, by making the cost of capital cheaper. They drop rates and the economy continues to pick up. It's like this dance. The only problem is that the Fed was late to the dance when these guys were calling it transitory. Inflation was not transitory 2 years ago. They should have raised rates sooner. Now, we can Monday morning quarterback. It's like Jake said, it's the toughest job in the world because they're dealing with a dysfunctional political system. So they're trying to do
believe it is. Everyone's hating on Powell, saying he's like incompetent or whatever. I'm like, dude, take his job for a week. See how that dude's got the hardest job in the country right now.
And that's what I mean. And I'm going to say it again on the podcast. They should have raised rates back in 2019, but Trump stopped them. And I remember in 2019, in December, January time, a lot of deals started going out of contract. Things started really slowing down.
No,
and Trump jumped in there and says, hey, let's stop this. We need to keep rates low. So that perpetuated it. And then obviously COVID came in, and there was the reason to keep rates low because of basically the economy is completely shut down. So rates were continually. They should have raised rates sooner, before the November 22 elections, but they didn't. But the reason why I'm bullish on insurance companies, they are the strongest companies in the country. If one fails, another one comes in. Everyone's thinking about AIG.
But we're not seeing them failing, though.
No, they're not, they don't, because the reason why their investments are very, very stable. I mean, income from these mutual life insurance companies, 60% of it comes from premiums. They're very conservative. They give out loans. They make money from giving out loans to the policyholders. They have corporate municipal bonds. They have preferred stocks. Once again, the policy loans, and they own grade A real estate. So you put that all together and you have a great model, and they've been doing this for over 150 years. These companies have not missed a dividend during the Great Recession, the Great Depression, wars. They've constantly paid over the last 150 years plus. It's a great place to put your money and reserve, as Jake likes to say, those baby money soldiers. So when you need some of them to go out and conquer a territory or take over a property, you have them there and you can deploy them. They're safe. You're still in your policy, uninterrupted. You're just taking basically what we call a policy loan out, putting that money, buying another asset, which we call the dual asset strategy. All of a sudden, you have 2 assets. Those baby money soldiers are doing their work. Once that asset is producing income and cash flow, you can pay back that policy loan. You can replenish your cash value right there, and then you have both of those assets. It's a long-term concept, but it's an amazing concept that the wealthy and banks have been using for over 150 years.
Yeah, and here's the thing, gang. Nothing is bulletproof. We're not saying that, this is indestructible, but we're talking about basic diversification here. We own businesses. Gino and I own businesses. We have checking accounts for those businesses within a bank, okay, to be very clear. We have personal checking accounts to pay bills and do our basic living, right? We own real estate. We have, there's a lot of, wealth and value in our real estate, but then there's also whole life, and there's the hub. Okay. whole life is the larger cash management protocol for this model, this strategy that we're talking about, where you're getting a death benefit to provide liquidity if you're a real estate investor for your family if you pass on. You're getting a rate of return for the money that's in the policy, and then you're able to utilize that money to borrow to put into your deals when the real estate deals come up. This is all we're saying, and I think it's very reasonable. It's not something that it's all or nothing type strategy, but I think this is a really sound way to also diversify and not have all your eggs in one basket.
Now, we have had a great run in multifamily, going from 0 units to over 250 million in assets. That's over 2,000 apartment deals that we've been able to purchase through our framework: buy right, manage right, and finance right.
Now, Jake and I, we created the Jake and Gino community back in 2015. We launched our first book, Build Our Profits. And since then, our students have closed over 60,000 units. That's over $4 billion in assets they've been able to close over the last 6 years.
And that's why this community has been so successful. We call it results-based education, and we pour back into the community everything that we've learned on our journey from 0 to 2,000 units, and all our systems and scale that we use on our very own property management and investing companies.
Jake, I love that. It's not just education, it's implementation. So what I want you to do, click on that link down below, apply to work with our team, see how we can help you on your journey in multifamily. Jake, we like to use whole life, and myself especially for my personal life. We always taught to budget and to save for those catastrophes. I don't want my money in a 401k where if I lose my job,
that's
or I have
not
no
even on the radar.
expense.
It's not even in this world. Like if you're,
and the reason why I mention that is I used to plow my money into a 401k. This is years and years ago. I stopped and I started funding my whole life policies. Yeah. So let's say the kids don't go to college, but you have the money in the whole life policy. If you need it, it's one of those things where there's a little bit of a barrier. You can't pull it out of a checking account right away. You need a day or two to pull it out. So you really need to think. It's a great thing. That's what I love about it. So it gives you the liquidity.
You're not going out and buying the Lambo maybe today because it's a little barrier there. You have to.
Or as Jake likes to say, you're not going out there and throwing some money in crypto and you're just like making that emotional purchase and you're hitting the button. All of a sudden, that money's there. But there's other ways to do it. My brother and I created a buy-sell agreement. We funded it with life insurance. Unfortunately, it was term. It wasn't whole life because I was Mr. Cheapskate back then. I'd still be paying into that policy. That would have the cash right in that policy that if something happened to one of the brothers, the other brother would get the business and the one that passed away would get the life insurance. Keyman insurance. That's a great thing if you have an employee and you want to be able to retain that employee. Thinking about getting whole life insurance on an employee. There's so many different ways to utilize this strategy. If you want to get on your children as well, I've done that. What you're trying to do, as Jake said, is you're trying to accumulate assets for the long term. And that's what the wealthy do. Businesses are amazing. That's what we're focusing on. Real estate's amazing. We're using whole life basically as that CapEx. If you're a multifamily investor, CapEx is in the whole life. If something happens to a roof or we have to make payroll, guess what? I can borrow the money out of that policy and it doesn't cost me anything. It's uninterrupted. It may cost me the policy loan, but my money's still earning interest. When I'm done with that expense, I can put it right back into the policy. So for me, it's a great stopgap. It's for short term and for long term, Jake.
Gino, speaking of the orange Lambo, there it goes right there. Yeah, just saying. Must be going to get groceries right now or something. So. No, I think this stuff is just something that we're not taught, and we're here just to open folks' eyes to other opportunities and other financial solutions that may benefit you. That look, you're not getting this in school, you're not getting this in college. This is the kind of stuff that. Really, there's folks that I've met throughout my life, and here's the thing: all the people that I know in my life that are worth over $10 million, every single one of them has whole life, and it's like this very like little. I don't want to call it like a secret society type thing, but most of the folks that I grew up with don't really own a whole lot of whole life, and then these rich people that I network with now, thanks to the podcast and the great success we've had with our real estate, you start to see very common themes. Oh, yes, I own multifamily real estate. I own whole life insurance. Like I own businesses. It's like, oh, well, hearing a common thread here. So look, that's all we're saying. I want to open your eyes to some other opportunities up there. So
yeah, well, last thing I want to say to everybody is if you're a young family and you're starting out and you say you can't afford whole life, at the very least get term and be with the ability to convert it to whole life. And the other thing I'll say about that, if you're a young family right now, please start planning for your estate. Create a will. If you've got kids, make sure you get guardianship on your kids because you don't want your kids going to your mother-in-law or your brother and saying, oh my, what happened? I didn't have the control. You have the control right now. Become a 100-year real estate investor. Have the long-term mindset. Take control because if you don't have an estate plan, the state has the estate plan for you. So please, at the very least,
Say that again. Say that again. People need to hear this.
Well, 67% of the U.S. population does not have an estate plan, but 100% of us do. Because if we don't have our own plan, the state has the plan for us. We have to follow the state's plan. And it's really, really important that if you're a young family out there, please, at the very least, create a simple will where you can, designate guardianship of your children if something may happen to you. Get term life insurance in their interim. If something happens to you, you can at least pay for expenses. You can at least pay for, funeral costs, at least pay for if you're a husband and you pass away, your wife will be able to get through those tough times. At the very least, term where you can convert it to whole life, Jake.
Amen. Gang, as always, we believe in buying deals for the long term. I'm Jake. He's the G Daddy, and we make it happen. We'll see you next time.